What if the secret to building lasting wealth isn't about chasing quick wins or hot stock tips, but about owning great businesses and patiently letting time and conviction do the heavy lifting? Are you ready to discover the timeless principles that can transform your investing journey? Welcome to Trade Investors' deep dive into Common Stocks and Uncommon Profits by Philip A. Fisher. Today, we'll uncover the legendary principles that have influenced generations of investors, including Warren Buffett. Get ready for a detailed guide to analyzing stocks the Fisher way. Philip Fisher wasn't just an investor. He was a pioneer in growth investing, focusing not just on numbers but on companies destined for long-term expansion. His philosophy has shaped countless investors and remains one of the most cited in finance. Fisher's approach goes beyond surface-level financial data. He believes that truly great investments are found in companies with durable growth prospects, exceptional management, and competitive advantages. The deeper your research, the higher your conviction. At the heart of Fisher's method are his 15 points, a checklist designed to distinguish genuinely great businesses from the ordinary. We'll walk through these in detail next. The starting point is market potential. Fisher insists on companies whose products and services are poised for growth, not one-time winners, but those with staying power in expanding markets. It's not enough to have a good product. Management must continually innovate. Fisher looks for leadership that's never satisfied and always searching for the next big improvement. Strong R&D is the engine of long-term growth. Fisher champions companies that invest in industry-leading innovation, ensuring they aren't left behind by competitors or changing trends. Sales drive revenue. Fisher wants to see not just innovative products, but a sales force capable of reaching more customers, opening new markets, and sustaining demand. Growth means little without profitability. Fisher prefers businesses with robust, defensible profit margins, a sign of pricing power and operational efficiency. Future success depends on maintaining edge. Fisher looks for management vigilant about cost control, operational improvements, and protecting their profitability against market pressures. Happy employees build resilient companies. Fisher evaluates whether a firm treats its staff fairly, attracts top talent, and maintains a positive workplace culture, key to stability and growth. Strong executive relationships foster clear communication, shared purpose, and strategic alignment. Fisher values leadership teams united by trust and common vision. A single-star CEO isn't enough. Fisher wants layers of capable leadership so the business thrives even through changes and succession challenges. Controls ensure accurate information for decision-making. Fisher favors firms with strong internal systems that prevent waste and keep management accountable. Fisher urges investors to look for unique industry factors, regulations, supply chains, customer base that may impact the company's prospects. True growth companies think long-term, investing in future opportunities even at short-term cost. Fisher warns against businesses sacrificing tomorrow for today's numbers. Ownership creates alignment. If managers are major shareholders, they'll think like owners, making decisions for lasting health, not quick payoffs. Transparency is non-negotiable. Fisher advises avoiding companies that hide bad news or lack honest communication with shareholders. Ethics drives sustainable success. Fisher values businesses led by principled management, avoiding shortcuts and serving the interests of all stakeholders. Fisher's famous scuttlebutt approach means investigating by asking around. The best insights often come from those interacting with the company day-to-day, not just official reports. Fisher's strategy demands patience. Enter only when conviction is high, and hold as long as the reasons to own remain valid. Sell not on price dips, but on changes in company quality or prospects. Some of the worst errors come from chasing undervalued stocks with poor prospects or spreading investments too thin. Stick to Fisher's principles. Buy great companies, not just bargains. Philip Fisher's teachings shaped not just individual investors but modern investment firms. His mix of qualitative and quantitative analysis is now standard practice for discerning investors worldwide. For Indian retail investors, Fisher's wisdom encourages finding companies serving emerging markets, driven by ethical, innovative leadership. Hold your winners for years, not days, and let compounding work its magic. As we wrap up, remember, great fortunes are built by owning great businesses, not by chasing quick wins. Do the deep work, invest with conviction, and let time and patience do the heavy lifting, and let long-term thinking guide your financial independence journey. Study Fisher's 15 points for every stock. Conduct real-world, scuttlebutt research. Build a portfolio of enduring quality and invest with conviction, patience, and principle. Thank you for joining us today. Don't forget to like, share, subscribe, and comment on which Fisher principle resonated most or which companies you're investigating using the 15 points approach.